Income tax. Income tax is a tax charged on the money individuals or businesses earn over a specific period. It became more widespread during the 19th and 20th centuries as governments sought stable ways to fund public services and national development. The amount owed is usually based on income level, with many countries using progressive tax systems where higher earnings are taxed at higher rates. Income tax helps finance essential services such as education, healthcare, infrastructure, and public safety. It is one of the most significant and widely recognized forms of taxation in the world. Sales tax. Sales tax is a tax added to the purchase price of goods and, in some places, certain services. It is collected by retailers at the point of sale and then passed on to the government. This type of tax became increasingly common as economies expanded and consumer spending grew. What makes sales tax distinct is that consumers pay it only when they make purchases rather than when they earn income. It plays an important role in generating government revenue while spreading the tax burden across everyday transactions. Property tax. Property tax is a recurring tax imposed on the ownership of real estate, including land, homes, and commercial buildings. Local governments have relied on property taxes for centuries to fund community services and infrastructure. The amount paid is generally based on the assessed value of the property rather than the owner's income. Property tax is especially important because it helps support schools, roads, emergency services, parks, and other local facilities. It is widely recognized as a key source of funding for municipal governments. Corporate tax. Corporate tax is a tax levied on the profits earned by companies and other business entities. As modern corporations became larger and more influential, governments introduced corporate taxation to ensure businesses contributed to public finances. Unlike income tax on individuals, corporate tax applies specifically to business profits after allowable expenses have been deducted. The tax helps fund government programs while balancing the benefits companies receive from operating within a country's economy. It remains an important part of national tax systems across the world. Capital gains tax. Capital gains tax is charged on the profit made when selling an asset for more than its original purchase price. Common assets include stocks, real estate, investment funds, and valuable collectibles. This form of taxation developed as financial markets expanded and investment activity became more common. What makes it distinct is that the tax applies only to the gain in value rather than the total selling price. Capital gains tax plays a significant role in investment decisions and government revenue from financial markets. Inheritance tax. Inheritance tax is a tax that may apply to assets passed from a deceased person to their heirs or beneficiaries. Different countries have adopted varying approaches to this tax, with some applying it broadly and others not using it at all. The tax is generally based on the value of the inherited estate above certain thresholds. It is distinct because it focuses on the transfer of wealth between generations rather than income or spending. Inheritance tax is often discussed in relation to wealth distribution and estate planning. Value-added tax. Value-added tax, commonly known as VAT, is a consumption tax applied at multiple stages of production and distribution whenever value is added to a product or service. It was first widely adopted in Europe and has since become a major source of government revenue in many countries around the world. Although businesses collect and account for the tax throughout the supply chain, the final cost is typically paid by the end consumer. VAT differs from a simple sales tax because it is collected in stages rather than only at the final sale. It is recognized as one of the most efficient and widely used indirect tax systems globally. Excise tax. Excise tax is a special tax placed on specific goods such as fuel, alcohol, tobacco, and certain luxury products. Governments have used excise taxes for centuries, both to generate revenue and to influence consumer behavior. Unlike general sales taxes, excise taxes apply only to selected products and are often included in the listed price. This makes them less visible to consumers, even though they can significantly increase the cost of certain items. Excise taxes are important because they help fund public programs while also discouraging the excessive use of products that may have social or environmental impacts.